Yo, it's your boy, the insurance junkie, your fiduciary fellow, the all-star advisor Alonzo Hall, and I've returned today with another ADH wealth solution. Today, we'll begin to discuss fulfilling all of your financial needs. To contribute to channel growth, the links are in the description. To schedule an appointment of your own, or to purchase life insurance directly up to $1 million with no medical exam and an instant decision, my information is in the description. Lastly, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. And now, here's our next feature. Salute. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I've returned today to weapon tap on your head with another ADH wealth solution. Today we're going to be taking a look at hedge funds and possibly also take a quick look at ETFs, because hedge funds are very complex, but it's not much to explain about them. Before we go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth, schedule a one-on-one appointment with a licensed financial professional, or to purchase life insurance directly up to $1 million in an instant decision with no medical exam. The links are in the description. As we proceed to give you what you need. As you can see, this is under the section unit 5 of the study manual, and it says here, other investment vehicles. So this lesson objective is to identify the suitability and risk issues of investing in a hedge fund. So, many companies rely on one of the exceptions from the definition of being an investment company under the Investment Company Act of 1940. They are not classified as FAC companies, UITs, or management companies, open-end or closed-end. These companies are commonly known as private investment companies. Some private investment companies can be what are known as hedge funds. Hedge funds are often organized as limited partnerships and are sold as private placements. Hedge funds are similar to mutual funds in that the investments are pooled and professionally managed, but they differ in that the hedge fund has more flexibility in the investment strategies employed. While hedging is the practice of attempting to limit risk, most hedge funds specify generating high returns as their primary investment objective. In attempting to achieve these returns, they tend to shoulder a substantial amount of risk. Hedge funds are typically aggressively managed and often construct portfolios of high-risk investments. Hedge funds use advanced and sometimes complicated investment strategies. Some of the more common strategies employed by hedge funds are highly leveraged portfolios, borrowing to purchase securities, the use of short positions, selling securities the portfolio does not own, the utilization of derivative products such as options and futures, currency speculation, commodity speculation, and the investment in politically unstable international markets. Most hedge funds are organized as private investment partnerships, allowing them to limit the number of investors, or require a large initial or minimum investment if they so desire. Some also require that the investors maintain the investment for a minimum length of time, e.g. 1 year, and to that extent they can be considered illiquid. The minimum holding requirements are known as lockup provisions. And if you'll see here, there's a knowledge check question, and it says, a private, unregulated investment company organized in such a way so as to invest and achieve high returns, utilizing debt leverage and derivative products such as options and margins, is best described as A, a mutual fund, B, a DPP, C, a REIT, or D, a hedge fund. The answer is D. Hedge funds are unregulated investments with a goal of achieving high returns. They do this by primarily utilizing strategies associated with risk, such as trading in commodities, currencies, and derivatives, and utilizing debt, leverage, and margin. So you'll see a lot of hedge funds and things like crypto. Let's take a look at ETFs really quickly, just so we can learn a little bit about that, because a lot of people like to talk about them but have no idea what the shit they are. So, exchange-traded funds and exchange-traded notes. ETFs, or an exchange-traded fund considered an equity security, invests in a specific group of stocks and generally does so to mimic a particular index, such as the S&P 500. In this way, an ETF is similar to a mutual fund that tracks an index. The difference is that the ETF trades like a stock on the floor of an exchange, and in regard to how it trades, is similar to a closed-end investment company rather than an open-end mutual fund. They are registered, however, as either an open-end fund or as a UIT, but they are obviously different in many ways. Because of the way they trade, an investor can take advantage of intraday price changes due to normal market forces, rather than just the underlying value of the stocks in the portfolio. And, unlike mutual fund, ETFs can be purchased on margin and sold short. Expenses tend to be lower than those of mutual funds, and management fee is also low. Consider that the portfolio is designed to track an index, and just as the securities contained in the index are unlikely to change, so are the securities in the fund portfolio. In other words, there is little trading activity required to keep the fund securities aligned with those in the index it is intended to track. This generally results in greater tax efficiency for the investor. On the other hand, every time a person purchases or sells shares, there is a commission, and those charges can add up over time. Understanding that ETF shares are not mutual fund shares, but are registered as open-end funds, it should be expected, and is common, that they are often compared to mutual fund shares. In that light, ETFs have some advantages and disadvantages to be considered when compared with an open-end mutual fund. Or, you could get an IUL, which does the exact same thing, but gives you a monthly return. We'll talk about that in another video. Exchange-traded notes. ETNs, or exchange-traded notes, are senior unsecured debt securities issued by a bank or financial institution. Therefore, they are backed by only the good faith and credit of the issuer. The notes track the performance of a particular market index, but do not represent ownership in a pool of securities the way share ownership of a fund does. ETNs are bond-like instruments with a stated maturity date, but they do not pay interest and offer no principal protection. Instead, ETN investors receive a cash payment linked to the performance of the underlying index minus management fees with the note when the note matures. Because the returns of ETNs are linked to the performance of a market index or a basket of securities, investors are also exposed to market risk. So, let's finish this out here. And this is Unit 5, again, of the study manual for a securities license or a financial professional license. Recall the advantages and disadvantages of ETFs. The following are some advantages of ETFs when compared with open-ended mutual funds. Pricing and ease of trading. Because individual ETF shares are traded on exchanges, they can be bought and sold at any time during the trading day at the price they are currently trading at, as opposed to mutual funds, which use forward pricing and are generally priced once at the end of the trading day. Margin. ETFs can be bought and sold short on margin like other ETPs. Mutual funds cannot be bought on margin, nor can they be sold short. Operating costs. ETFs traditionally have operating costs and expenses that are lower than most mutual funds. Tax efficiencies. ETFs sometimes do distribute capital gains to shareholders like mutual funds do, but this is rare. Understanding that these capital gains distributions are not likely There are no further tax consequences with ETF shares until investors sell their shares. This may be the single greatest advantage associated with ETFs. The following are some disadvantages of ETFs when compared to open-end mutual funds. Commissions. The purchase or sale of an ETF shares is a commissionable transaction. The commissions paid can erode the low expense advantages of ETFs. This would have the greatest impact when trading in and out of ETF shares frequently or when investing smaller sums of money. Overtrading. Given the ability to trade in and out of ETFs easily, the temptation to do so is possible. Excessive trading can eliminate the advantages associated with investing in a diversified portfolio and add to overall commissions being paid by the investor, further eroding any of the other expense and operating cost advantages associated with ETFs. Market influences on the price. Because ETFs trade on exchanges, share prices can be influenced by market forces, such as supply and demand, like any other ETP. In this light, investors need to recognize that just as they might receive less than book value per share when selling corporate shares of stock, they might also receive less than NAV, net asset value, per share when selling ETF shares. Lesson Objective 5M to identify the risks of Etns. Exchange-traded notes are senior unsecured debt securities issued by a bank or financial institution. Therefore, they are only backed by the good faith and credit of the issuer. The notes track the performance of a particular market index, but do not represent ownership in a pool of securities the way that share ownership of a fund does. Etns are a bond-like instrument with a stated maturity date, but they do not pay interest and offer no principal protection. Instead, Etn investors receive a cash payment linked to the performance of the underlying index minimums, index minus management fees when the note matures. Because the returns of Etns are linked to the performance of a market index or basket of securities, investors are also exposed to market risk. While the market price of an ETN, in theory, depends on the performance of the underlying index or benchmark, the ETN has an additional risk compared with an ETF. If the credit of the underwriting bank should falter, the note might lose value in the same way any other senior debt of the issuer would. Additionally, there are limits to the size of ETN issues. This means, with limited availability, there are times when an ETN might trade as a premium to its inherent valuation. Investors purchasing at a premium could be subject to losses later, depending on the value of the note at maturity. Take note. Primary risk associated is default risk. Liquidity risk is also a common concern. Even though they are called exchange-traded, very few of them have ever actually been listed on an exchange. So, knowledge check. They have two questions here. Question 1. All of the following are true for ETFs except A. ETFs can be bought or sold throughout the trading day. B. ETFs are not marginable security. C. ETF share prices are subject to market forces like supply and demand. Or D. ETF transactions are commissionable trades. And 2. An investor has placed money in a debt-like instrument issued by a financial institution and linked to the performance of the S&P 500 index. From the investment, which has a stated maturity date but makes no interest payments, the investor anticipates receiving a cash payment minus any applicable management fees when the instrument matures. This describes which of the following investments: A. A municipal bond. B. A DPP, direct participation program. C. An ETN, exchange traded note. Or D. A variable annuity. And the answers are, for question 1, B. ETFs trade as all other exchange traded products, ETPs, do. Commissionable transactions can occur throughout the trading day where prices are subject to all normal market forces. They can be purchased on margin. And the answer to question 2 is C, Etns. Etns are debt-like instruments issued by banks and other financial institutions that trade on exchanges. Their performance is generally linked to a specific market index. At maturity of the note, investors receive a cash payment minus any management fees. So, ladies and gentlemen, that's it for today's lesson from the study manual on investment vehicles or alternative investment vehicles. With that being said, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, schedule a one-on-one appointment with a licensed financial professional or purchase life insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. With that being said, wipe ass, work in progress every day, and see success. Salute, salute, salute. Hey folks. This last video was sponsored by my company, where we help people like you to reach their financial goals. We do this through a simple conversation where we help to identify and then protect your lifestyle. And then we implement a plan. The process starts at about an hour. So, if you want more information or you want to schedule a consult, contact me via the information in the description box, and let's talk and see if we're actually a great fit for each other. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Thank you, and enjoy life.